Have you ever wondered how companies like Apple or Tesla raise billions of dollars? And how ordinary people can become part owners of those companies? Or why stock prices go up and down every single second? Today, we're going to deeply understand what the stock market is, how it started, how it works, and what it actually contains. From absolute basics to a clearer, more detailed breakdown in the simplest way possible. By the end of this video, you'll clearly understand the origin of the stock market, how it evolved over time, how trading actually happens, who participates in it, what makes prices move, and why it exists in the first place. Let's begin from the very beginning.
The origin of the stock market.
To understand the stock market, we have to travel back more than 400 years. In the early 1600s, European countries were competing to explore and trade with Asia and the Americas. Spices, silk, tea, and precious metals were extremely valuable. But there was a problem. Sending ships across oceans was incredibly expensive and extremely risky. Ships could sink, pirates could attack, entire voyages could fail. One powerful company, the Dutch East India Company, needed massive funding to build ships and finance long expeditions. Instead of borrowing money from a single wealthy person, they introduced a revolutionary idea. They divided ownership of the company into small pieces called shares. A share is simply a small unit of ownership in a company. If you bought a share, you owned a tiny percentage of the company. If the company made profits, you received part of those profits. In 1602, investors began trading these shares in Amsterdam, creating what's widely considered the first official stock exchange, the Amsterdam Stock Exchange. This moment changed financial history forever. Over time, this idea spread across the world. In 1792, 24 traders in the United States signed the Buttonwood Agreement under a tree on Wall Street. This later became the New York Stock Exchange, often called the NYSE. Then in 1971, something revolutionary happened again. The NASDAQ became the world's first electronic stock exchange. Instead of people shouting on a trading floor, computers began matching buyers and sellers. Today, trades happen in milliseconds, faster than the blink of an eye. Now let's understand, what is a stock market? Now let's simplify everything. The stock market is a marketplace where people buy and sell ownership in companies. Think of it like Amazon. But instead of buying products, people buy tiny pieces of businesses. When you buy a stock, you become a partial owner. You may receive dividends, a portion of company profits paid to shareholders. You benefit if the company grows and becomes more valuable. Let's explain an important word. Dividend. A dividend is money a company pays its shareholders from its profits. Not all companies pay dividends. Many reinvest profits to grow faster. When a company wants to raise money for expansion, like building factories, hiring employees, or launching new products, it can list its shares on a stock exchange. This process of offering shares to the public for the first time is called an IPO, initial public offering. After that, investors trade those shares among themselves. That's the stock market in its simplest form. Now let's understand, what does the stock market contain? The stock market isn't just stocks, it's a whole system. Let's break it down clearly. Number one, what is a stock or share? These are ownership units of companies like Apple Incorporated, Microsoft, Tesla. If a company has 1 million shares and you own 1,000 shares, you own 0.1% of that company. Simple math, real ownership. Number two, stock exchanges. These are official marketplaces where stocks are traded, such as New York Stock Exchange, NASDAQ, London Stock Exchange. An exchange ensures trades happen fairly and transparently. Number three, market indices. An index tracks the performance of a group of stocks. For example, S&P 500 tracks 500 large U.S. companies. Dow Jones Industrial Average tracks 30 major companies. If the S&P 500 goes up, it means large companies overall are performing well. Think of indices as the temperature of the market. Number four, market participants. Different people and institutions participate. Retail investors, regular individuals like you and me, institutional investors, large organizations managing money, mutual funds, pension funds, hedge funds. Brokers, platforms, or firms that execute trades for investors. Market makers, firms that ensure there is always a buyer and seller available. Number 5, regulators. Markets need rules. In the United States, the U.S. Securities and Exchange Commission, SEC, ensures companies follow laws and investors are protected. Regulators prevent fraud, insider trading, and manipulation. Let's now understand how the stock market actually works. Now let's slow this down and really understand it. Step 1, a company goes public, IPO. Imagine a fast-growing startup. It needs $1 billion to expand globally. Instead of borrowing from a bank, it decides to sell shares. Investment banks help determine how many shares to issue. What price to sell them at on IPO day, shares are sold to investors. After that, trading begins in the secondary market. Step 2, buying and selling. When you open a trading app and press buy, you place an order. Your broker sends that order to the exchange. The exchange matches your buy order with someone selling. The trade executes. This happens in milliseconds. Bid price, the highest price a buyer is willing to pay. Ask price, the lowest price a seller is willing to accept. Spread, the difference between bid and ask price. When buyers outnumber sellers, price rises. When sellers outnumber buyers, price falls. This is called supply and demand. Step 3, why prices? Move prices don't move randomly. They move because of new information and expectations. Examples: company earnings reports. Interest rate decisions by the Federal Reserve economic data, like inflation, political events, technological breakthroughs. Most importantly, stock prices reflect expectations about the future, not the past. If investors believe a company will grow strongly in the future, the price rises today. Now let's understand the types of markets inside the stock market. There are two main sections, primary market and secondary market. Primary market. This is where companies sell shares directly to investors during an IPO. Money goes to the company. Secondary market. This is where investors trade shares among themselves every day. When you buy shares of Apple, you're buying from another investor, not directly from Apple. Most trading happens here. The stock market exists for two powerful reasons. One, for companies. Raise capital, expand operations. Hire employees, fund innovation, compete globally. Without stock markets, companies would grow much slower. 2, for investors. Build long-term wealth, protect against inflation, participate in economic growth. Over long periods, stock markets have historically grown alongside economies. It connects businesses that need money with people who have money and want returns. In simple words, the stock market is a bridge between opportunity and capital. Now let's be realistic. The stock market is not a guaranteed money machine. Prices fluctuate daily. This is called volatility. There are bull markets, long periods when prices rise. Bear markets, long periods when prices fall. Investing involves risk. Emotions drive markets more than most people realize. Fear causes panic selling. Greed causes bubbles. Successful investors control emotions. Let's summarize everything clearly. The stock market. Started over 400 years ago, allows companies to raise money, allows individuals to become partial owners, operates through exchanges, moves based on supply, demand, and expectations, contains stocks, indices, participants, and regulators. At its core, the stock market is not gambling. It's a system that fuels innovation, growth, and wealth creation. And now, you understand how it truly works. If you've made it this far, you're not here for hype. You're here to understand how money really works, and that already puts you ahead of most people. The stock market isn't gambling. It isn't magic. It's a system. And when you understand the system, you stop reacting emotionally and start thinking strategically. That's what this channel is about. Clear thinking, long-term wealth. Real financial literacy, explained simply without noise. If this video helped you see the market differently, do 3 small things. First, subscribe. Not because it helps the algorithm, but because it helps you. Every video here is designed to compound your understanding, just like investing compounds wealth. Second, like the video. Think of it as a signal. When you like content like this, platforms show you more intelligent material instead of random financial hype. You train your feed the same way you train your portfolio. Third, share this with one serious person, not everyone, just one person who actually wants to grow. Because conversations about money change lives, and most people never have them. We're building something long-term here, a community of people who don't chase trends, they understand fundamentals. And if you stay consistent with learning like this, years from now, you won't just understand the stock market. You'll benefit from it. I'll see you in the next video.